Most investors talk about markets as if they move on emotion alone. Fear spikes, optimism returns, narratives rotate, and price appears to drift from one headline to the next. But that interpretation misses the structure underneath. Markets do not reprice in a vacuum. They reprice as liquidity conditions change, as balance sheets expand or contract, as collateral values shift, and as capital is forced to move through a system with timing constraints. That is the real dislocation. People look at price and think they are seeing the cause. In many cases, they are only seeing the delayed effect. A rally is often interpreted as confidence when it may simply be the result of easing financial conditions. A drawdown is often framed as panic when it may be the mechanical consequence of tighter dollar liquidity, higher real yields, or leveraged positioning being forced to unwind. This is why so many investors remain structurally late. They anchor to narrative after liquidity has already turned. They become bullish after capital has already been deployed. They become defensive after the drainage has already begun. The mismatch is not just price versus sentiment. It is narrative versus capital flow. It is volatility versus collateral conditions. It is public interpretation versus institutional timing. A useful way to correct that mismatch is to stop treating liquidity as a vague backdrop and start treating it as a clock. Not a clock in the sense of precision timing down to the day. A clock in the sense of identifiable phases. Liquidity expands, it gets transmitted through balance sheets. Risk appetite broadens, leverage accumulates, reflexivity builds. Then the system tightens, rollover stress appears, marginal borrowers weaken, leverage becomes unstable, and the same process runs in reverse. This is not mystical, it is monetary plumbing, incentives, and positioning. When investors lack this framework, they confuse randomness with phase transition. They mistake a late-stage squeeze for a new structural bull leg. They mistake temporary weakness inside an improving liquidity backdrop for systemic collapse. And because they do not understand the clock, they keep reacting to the last move instead of positioning for the next regime. That is the core problem. The market looks random when you cannot see the timing mechanism. But once liquidity becomes the reference point, price starts to look less like chaos and more like a downstream response. A liquidity clock begins with macro structure because capital does not flow freely. It flows through constraints. One of the first constraints is the interest rate environment. When policy rates rise, the cost of capital rises with them. Discount rates move higher, duration-sensitive assets reprice, and speculative capital loses oxygen. That is not just a valuation issue. It is a system-wide tightening in the hurdle rate required for risk-taking. The second force is real yields. Nominal rates alone do not tell the full story. What matters is the return available after inflation expectations are considered. When real yields rise, cash and short-duration sovereign paper become more competitive relative to long-duration growth assets, venture allocations, and highly reflexive crypto positioning. Higher real yields act like gravity. They raise the opportunity cost of holding volatile assets with no near-term cash flow. The third force is net liquidity in the sovereign funding system. This includes treasury issuance patterns, the pace of deficit financing, central bank balance sheet policy, and the distribution of reserves through the banking system. When governments increase issuance and the private market must absorb large amounts of duration, liquidity can be drained from risk assets even if headlines sound neutral. When central banks slow balance sheet contraction, engage in repo support, or indirectly stabilize funding markets, that drainage can ease even without formal rate cuts. A fourth force is debt rollover pressure. In a highly leveraged system, a large share of sovereign, corporate, and household obligations matures into whatever rate environment exists at the time of refinancing. When cheap debt rolls into expensive debt, cash flow gets redirected from productive activity toward debt service. That slows demand, reduces credit creation, and weakens the marginal bid for risk assets. A fifth force is fiscal expansion. Fiscal deficits are not automatically bullish for markets, but large government spending programs inject demand and redistribute liquidity into the private sector. If that fiscal flow lands in an environment where monetary conditions are no longer tightening aggressively, it can support asset repricing even before the public narrative catches up. This is why markets can rise while economic commentary remains pessimistic. The system is forward-looking, but more importantly, it is liquidity sensitive. Observation, rate direction, real yield behavior, sovereign issuance, and debt rollover conditions create the macro perimeter within which all asset pricing takes place. Interpretation, risk assets respond not just to growth expectations, but to how much balance sheet capacity and collateral flexibility remain inside the system. Probabilistic implication, when multiple macro forces shift from drainage toward stabilization, capital begins to extend duration and volatility tolerance again, even before consensus becomes constructive. That is the structural implication. Liquidity changes the terms of engagement before it changes the story investors tell themselves. If the liquidity clock explains the environment, institutional positioning reveals who is already responding to it. One observable signal is ETF flow behavior. Spot Bitcoin ETFs, broad equity ETFs, and fixed income duration funds all act as transmission channels for capital preference. When ETF flows accelerate into risk assets during a period of loosening financial conditions, that is not merely enthusiasm. It is a visible expression of asset allocator preference under a new liquidity regime. Observation, persistent inflows into regulated vehicles often indicate that capital wants exposure without operational friction. Interpretation, institutions prefer wrapper efficiency when macro conditions justify directional allocation. Probabilistic implication, when flows enter through passive or semi-passive vehicles, the move can persist longer than sentiment alone would suggest because it reflects mandate-level positioning rather than retail impulse. A second signal is corporate treasury behavior. Corporations that allocate into hard assets, extend duration selectively, or reduce idle cash exposure are making incentive-based decisions about purchasing power preservation and balance sheet optimization. Observation, treasury allocation shifts usually occur slowly and are tied to capital preservation logic, not narrative excitement. Interpretation, when treasuries move, they often reflect growing discomfort with fiat erosion or low real return on cash holdings over a strategic horizon. Probabilistic implication, slow-moving capital can become a stabilizing bid under the market, even if it does not generate explosive momentum. A third signal is sovereign and quasi-sovereign behavior. Pension funds, sovereign wealth vehicles, and state-adjacent institutions rarely move first in visible ways, but when they do, they often care about reserve durability, currency diversification, and long-horizon convexity. Observation, sovereign capital generally allocates with a framework centered on regime resilience, not quarterly excitement. Interpretation, interest in hard monetary assets or scarce collateral often rises when confidence in long-term fiat purchasing power weakens. Probabilistic implication, this type of demand can compress available supply over time rather than immediately reprice the asset in a straight line. A fourth signal is stablecoin supply. In crypto-native markets, stablecoin expansion functions as a rough measure of deployable digital liquidity. Stablecoin contraction often signals defensive positioning, redemptions, or lower speculative appetite. Stablecoin expansion suggests new capital entering the system or idle capital preparing to rotate into risk. Observation, a rising stablecoin base often precedes broader alt liquidity and increased on-chain activity. Interpretation, dry powder is building inside the system. Probabilistic implication, if macro conditions are not hostile, expanding stablecoin supply can support further risk transmission across digital assets. A fifth signal is exchange reserve behavior. When exchange reserves of Bitcoin decline over time, especially alongside evidence of long-duration holding, it suggests supply is moving away from immediate sell venues. Observation, coins leaving exchanges reduce instantly available float. Interpretation, market participants may be prioritizing custody and duration over short-term distribution. Probabilistic implication, reduced liquid supply increases sensitivity to new demand, which can amplify repricing during positive liquidity phases. The key point is simple: observation is not interpretation, and interpretation is not certainty. But when ETF access expands, stablecoin balances rise, exchange reserves fall, and long-duration capital begins to enter through regulated channels, the structure of the market changes. Not emotionally, mechanically. Behavioral and derivatives data tell you whether the market is building on durable positioning or unstable leverage. Start with funding rates. In perpetual futures markets, funding reflects the balance between long and short demand. When funding turns excessively positive, it often means longs are becoming crowded and paying a premium to maintain exposure. Observation: persistently elevated funding is a leverage signal, not a pure strength signal. Interpretation: price may still rise, but the move becomes increasingly dependent on fragile leverage rather than healthy spot demand. Probabilistic implication: the higher the crowding, the more violent the unwind if momentum stalls. Then look at open interest. Open interest rising alongside price can mean fresh conviction, but context matters. If open interest expands while spot volume remains weak and funding becomes stretched, the market may be building a leveraged tower rather than a durable base. Observation: open interest measures exposure, not wisdom. Interpretation: rising OI without supporting spot absorption often increases liquidation sensitivity. Probabilistic implication: the market becomes path-dependent, where a modest reversal can cascade into forced selling. Liquidation zones matter because derivatives markets are nonlinear. Once price approaches dense clusters of stops or forced liquidation levels, the market can accelerate mechanically. That acceleration gets misread as conviction, when it is often just market structure consuming trapped positioning. Now, move on chain. One of the most useful behavioral references is hodl wave behavior or coin age distribution. When older cohorts remain inactive while younger cohorts rotate more aggressively, it suggests long-term holders are not distributing heavily into strength. Observation: dormant supply staying dormant limits structurally available sell pressure. Interpretation: the marginal seller is often shorter duration capital. Probabilistic implication: if new demand enters while old supply remains inactive, the upside response can become convex. A second on-chain signal is realized profit and loss behavior. When market participants begin realizing outsized profits into rallies, it can indicate distribution. When realized losses spike during declines, weak hands are exiting under pressure. Observation: realized behavior reveals whether participants are strengthening the trend or exhausting themselves inside it. Interpretation: healthy trends often climb with moderate profit realization, not euphoric distribution. Probabilistic implication: when realized losses flush late buyers but long-term holder conviction remains intact, reset conditions improve. A third behavioral signal is exchange inflow and outflow composition. Coins moving to exchanges during euphoric phases suggest distribution risk. Coins leaving exchanges during consolidation suggest accumulation or at least reduced intent to sell. Observation: venue choice reflects behavioral intention. Interpretation: liquidity is not only about money entering the system, but about asset supply choosing whether to meet that money. Probabilistic implication: a market with improving liquidity and declining liquid supply carries positive asymmetry relative to a market with improving narrative but rising sell-side inventory. That brings us to convexity. Risk asymmetry emerges when downside is increasingly limited by balance sheet improvement, while upside remains sensitive to incremental demand because liquid supply is constrained. That does not guarantee outcome, but it changes expected value, and serious positioning is about expected value, not emotional certainty. So what does a rational allocator do with this framework? Not predict, not chase, not confuse a liquidity phase with invincibility. Strategic positioning begins with containment. When the liquidity clock is hostile, capital preservation matters more than expansion. That means respecting cash, short duration optionality, and lower beta exposure. When the liquidity backdrop begins to stabilize, the objective is not to go all in. It is to increase exposure where convexity is highest relative to downside risk. That is a different mentality. It means thinking in distributions, not declarations. It means preferring assets with structural scarcity, improving demand pathways, and lower dependence on heroic assumptions. It means understanding Bitcoin not as a slogan, but as a hard monetary asset whose performance is highly sensitive to global liquidity conditions and institutional access. Allocation discipline matters here. A rational actor does not size positions based on conviction alone. They size based on fragility, liquidity depth, and tolerance for variance. Convex opportunities are useful only if position sizing allows survival through volatility. The market rewards endurance more often than enthusiasm. Liquidity awareness also changes timing behavior. Instead of waiting for full narrative comfort, the allocator monitors phase shifts. Are real yields peaking or still rising? Is net liquidity being drained or quietly restored? Are ETF flows broadening participation? Is stablecoin supply expanding? Are exchange reserves falling? Is open interest healthy or dangerously crowded? These questions are better than asking whether the market feels bullish, because feelings do not price assets, incentives do. This framework also protects against overreaction. Not every drawdown inside an improving liquidity regime is a structural break. Not every rally inside a tightening regime is the beginning of a durable expansion. The clock matters because phase matters. And phase determines whether price action should be interpreted as continuation, reflexive squeeze, or temporary relief. Strategic patience is not passivity, it is disciplined sequencing. You do not deploy because the crowd is finally convinced. You deploy because observation, interpretation, and probability begin to align. And you do not stay deployed out of loyalty to a narrative. You stay deployed only while the structural conditions that created the edge remain intact. That is how serious capital moves, not with certainty, with calibration, not with noise, with structure. This is 21 Protocol. Freedom is not a feeling, it's a structure.